as far as inflation is concerned, whatever you have seen in terms of the recent move upwards is more due to food inflation, which is going to be more transient in nature. So we do believe that the monetary authorities will have room to cut interest rates going forward in 2024. If you remember, in fact, India was one of the first markets which paused on the interest rate cycle last time around. And with Fed also looking at interest rate cuts next year, we do believe that India has a potential to see interest rate cuts next year, especially given that there is positive real rate already. As far as growth is concerned, I think we have been growing at about 7.6%. If you look at the second quarter GDP for the country, 7% for next year seems achievable at this point of time.
And Harsha, is the technology sector expected to be a key cornerstone again in 2024 for the Indian stock market? We have a real estate investment trust here, Capital Land India Trust, that does invest in IT parks across India, and it's definitely a favourite with the local investors in terms of its trading turnover here in Singapore.
We have been preferring domestic growth-oriented companies as far as our portfolios are concerned. Since domestic growth has been more resilient as compared to global growth, we believe that there are more opportunities on the domestic businesses side. As far as tech is concerned, clearly Fed pivot is going to help them in terms of the valuation re-rating. However, if you look at the business momentum, we have not really seen any great pickup as yet. We have seen some bit of slowness in terms of hiring as well. So overall, it remains to be seen over the next couple of quarters whether growth comes back into the tech segment. As I said, we do believe domestic segments are much better placed at this point of time as compared to some of the global-facing industries, including IT.
Right. Harsha, very quickly, what are the top 3 sectors that you would invest in incrementally, for every extra dollar that you get into the fund? And what are the 3 sectors that you would be underweight on in India right now?
Incremental money probably will go into banking and financials because this is one segment which is very, very linked to overall economic growth in the country. And the sector hasn't done much in the past 1 year or so, especially the large cap banks. And we do believe that with credit growth growing in the mid-teens and no asset quality issues at this point of time, and also ownership not being as high as what it used to be in the previous cycles, there is money to be made in the banking and financial sector. As far as the underweight sectors are concerned, IT, metals, these are the 2 underweight sectors at this point of time, both global facing. And we do believe that global growth is going to be more subdued as compared to domestic growth. And hence our positioning has been more towards domestic companies.